Hi, my name is Chris Rawley. I am the CEO and founder of Harvest Returns, and I want to thank you for joining us in our Growing Your Wealth with Investments in Agriculture webinar. I'm going to start by telling you a little bit about myself and our company and why we started it. So I grew up in Texas. I served as a naval officer for about 26 years, active in reserve. Went to business school. I've worked in a variety of industries, including commercial real estate, information technology, and defense. And most importantly, I've been a self-directed investor for my entire adult life. After I'd invested in real estate and commercial real estate, residential and commercial real estate and land for a number of years, I became very interested in agriculture as an asset class. And the reason is I became interested was because I've lived and traveled all over the world and visited more than 50 countries. And the one thing I notice wherever I go, no matter how poverty stricken or war torn a place is, that people have to eat. People are growing and raising something. Most people, especially in the US, take their food for granted. They have no idea how it's produced, and they have no idea about how money is extracted from the agriculture industry. There's institutions out there that are making money investing in farming, but most individuals have no exposure to it. And that makes sense because the average farm in the US is valued about $4 million, and it makes these assets pretty much out of the reach of most individual investors. So this is why my co-founder Austin Manis and I started this company, is to make agriculture investments easier for the everyday investor. Before I talk about why we think agriculture is such a compelling asset class, I'd like to spend some time discussing the way I see the current investment market. So most people probably have some part of their retirement portfolio in the stock markets, either through a 401k or an IRA or individual account. But most measures, and this one here on the graph is the Buffett indicator, show that the current market is more overvalued than the housing bubble peak in 2007. And actually that we're currently in the second most overvalued stock market ever. On top of the market being elevated, the volatility has spiked in the past few months, as most of you know if you've checked your stocks statements. On this chart, you can see the higher the index price is, the greater volatility, which means basically an indication of fear in the stock market and a potential sell-off. Some people think that what's driving this volatility is algorithmic trading by robo-advisors. So Blackstone's advisory group says that about 85% of the stock market is now driven by trading systems. And these trading systems are heavily reliant on complex math formulas, high-speed computer trading programs that are trading in high volume, which is driving these ups and downs and wild swings in the stock market. That can make a lot of people nervous. So the traditional investment advice is to diversify your stock portfolio by adding some corporate bonds. However, if you look at today's fixed income securities, most advisors think they're in a bear market. Interest rate risk is still high. Yields are still low, and nobody, including the Federal Reserve Board, really knows which direction interest rates are going to move this year. So a lot of people like real estate, and I am one of them. I love investing in real estate, especially multifamily real estate. It's a tangible asset. It's not correlated to the stock market, but these cap rates, basically the yield from the investments, are shrinking. Many apartment markets are overheated with too many buyers chasing too few properties. So all these market drivers are increasingly driving investment managers, professional investment managers like hedge funds, pension funds, private equity firms, university endowments, to look at alternatives. And what's an alternative investment? Well, it includes this thing called natural resources, which is oil and gas, timber, and farming. These investments, these alternatives, offer portfolio diversification with assets that are not correlated to the stock and bond markets, meaning that when there's corrections in the stock or bond markets, they don't impact alternative investments. They're able to reduce risk in a portfolio. Investment managers are also looking for higher returns from alternative investments than the traditional safe havens of cash or treasuries can provide. So we think that agriculture investments meet all the criteria for a safe investment, alternative investment. And there's a few reasons for that. First, private investments in farming or timber involve real assets like land that are a hedge against the erosion of your portfolio's principal through inflation. These investments are uncorrelated with stock and bond markets, and they're generally immune to economic cycles because people still have to eat during recessions. Most importantly, if you look at the returns, US farmland, which is just one piece of the entire investing universe, has outperformed all these other indices over the long term from the past 30 years or so. S&P 500, AAA bonds, REITs, gold, etc. When you talk about investing in ag, people really don't know what you mean until you kind of break it down for them. And this is kind of the way I have segmented the agriculture investment market and help people understand what you're investing in. First of these is timber. So obviously timber goes into a lot of products we use. It goes into construction in our houses, goes into paper, it goes into that cardboard that you get every day delivery of your Amazon boxes. Timber is a long-term investment. It's outperformed stock and bond markets from 1970s to the 2010s, and it performs well when there's a bear market in the stock market. And most people, when they think of agriculture, they think about driving through the country through cornfields and row crops. So row crops includes things like these annual crops like soy, wheat, corn. The investments are tied to the price of a commodity and the price of the underlying land. If a segment of the row crop is organic, and I'll talk more about that later. Livestock, this is mostly meat and dairy, poultry, pork. These are capital intensive operations to establish, but you can provide solid returns for investors. Consumers are especially looking these days for grass-fed, grass-finished meat and humanely raised animal products. There's a fairly new component of agriculture called indoor agriculture, and it consists of things like aquaponics, which is growing plants that are fertilized by the waste of fish, hydroponics, which is growing plants without soil, aquaculture. Indoor aquaculture is growing fish and hatcheries, things like that, and then vertical farming, which includes things like urban farming, growing food in the city. Permanent crops is sort of the opposite of row crops. These are fruits and vegetables, tree nuts, specialty crops, horticulture, flowers, nursery crops, traditionally a higher return profile than row crops. Tree crops take longer to grow, so they are better for investors with long-term horizons, just like timber. Then there's this thing I sort of classify as specialty products, specialized growing. And this is driven by the consumer demand with more specialized diets, vegan diets, high protein diets, low carb diets, organic, non-GMO, gluten-free, all these sorts of things. Organic produce in particular can drive higher prices with lower price volatility than conventionally raised crops. So those are types of investments you can access, and just a little bit about the characteristics of each one. There's a few trends that I'd like to highlight that are driving the agricultural investment spectrum. And the first that I already mentioned is organics, which is growing into a very significant market here in the US. A lot of organic produce is still produced outside the US and has to be shipped in to meet that demand. But that's changing as more and more farmers, conventional farmers, convert over to agriculture, and more types of growing, such as indoor agriculture, spring up that are growing organics from the start. Then there's this category of precision agriculture, ag tech, you often hear. It involves a variety of technologies that helps farmers increase their profits and their crop yields. Precision agriculture generally involves geospatial positioning technology that do things like help auto steer tractors, basically plant, fertilize, and harvest crops more precisely with less waste, more effectively. It also involves the use of satellites, drones, in-soil sensors that are tied together to help farmers monitor their fields in real time, then upload that data into the cloud and analyze it to make good farming and operational decisions. Finally, you have this category that I've already mentioned called indoor agriculture. There are several benefits to this from the investor standpoint. Growing food indoors controls a lot of the variables that make outdoor agriculture risky, such as weather, rain, and pest infestations. Indoor agriculture allows food to be grown more efficiently with less water than growing outdoors. The technologies also help food to be produced closer to the consumer. So you're not trucking it across country or across the world, shipping it across the world, and that reduces energy costs, and it makes the fruits and the vegetable that more fresh when they get to the consumer. So people ask us, what are you looking for when you host a farm investment on the Harvest Returns platform? What are the types of things that you look for? We have had hundreds of farmers come to us that want to raise hundreds of millions of dollars, but very few of those farmers actually meet our investment criteria. And I want to talk a little bit about what that is. First of all, we're serving what I see as an underserved farmer producer market that is farm operations, the range between 500,000 and roughly $3 million. There's farmers come to us when they are combining their investments with maybe traditional ag credit, bank financing, and they need to bring in equity investments, or when they want to do something creative and out of the norm. The U.S. in particular farming system is optimized to support farmers with the same kind of loans that their fathers and grandfathers were using. And just as an aside note, most farmers in the U.S., 98% of them are family farmers. You hear a lot about corporate agriculture, but it's not really true. There's farmers that are most of the farms in the U.S. are owned by families. Most of the farms throughout the world are. So we're looking for growers with an experienced track record. This is farmers that have been doing this multi-generations in their families, or are educated in what they're growing, savvy in business, savvy in bringing, maybe have raised capital before in a previous manner. These are the kind of investors that are the kind of farmers that we want to list, the projects we want to list on our platform for our investors, because we want them to be able to produce the returns that they say they can produce. We're looking at an emphasis on sustainability, and that's a word that can be defined in many different ways. But when I say it, we're talking about investments that are economically sustainable, economically viable, produce the returns as projected, that are socially sustainable, maybe making a good impact to rural areas by bringing jobs, things like that, and also environmentally sustainable. And that's look at a lot of the new growing methods, whether it's row crops with cover, no tillage type of crops, which helps regenerate the soil, or whether it's organic, fewer chemicals, indoor agriculture, lower water consumption, humanely raised livestock, all those types of things. And what are the returns? It really depends based on the risk profile. Our platform offers projects that are higher return, higher risk, and a little bit lower return, lower risk. So, for example, we did a debt note last year that's investors are receiving a quarterly 8% return on that. And that's sort of at the low end of what we're talking where some of our investments that have equity components might produce north of a 10% return. So how does this work? Maybe this sounds interesting to you. It's a fairly simple with the way we created our platform to aggregate these investments of a variety of geographies, a variety of crop types, a variety of types of investment structures from the different farmers and entrepreneurs that come to us. And we want to make this as easy as possible for these investments, for you to access the investments. In fact, our investments start at $5,000 minimum, range up to about $25,000. Again, those are the minimums investments. But we want people to be able to invest a portion of their portfolio. So the first thing you do is you can set up a profile on the Harvest Returns platform. You basically review and sign the offering docs. These are standard documents you would find in any private placement syndication, SEC compliant, and then you fund your investment. You can fund it with an ACH, a wire transfer, a check, pretty much any way we can help you fund your investment. Then once that escrow closes, the investment, the farmer receives their capital and they operate their operation, and you start to receive regular updates. You also receive your tax documentation, your K-1 forms. All this is done online, and you're receiving distributions. So those might be quarterly distributions, they might be annual distributions, returns of principal when the project exits. People ask, well, how long do these projects take? Well, currently our investments range anywhere from 24 months up to basically in perpetuity, multiple years, which that longer term range. So one thing that we're very excited about, and it might apply to some of the investors that are listening, is something called our Sustainable Agriculture Opportunity Zone Fund. The Opportunity Zone Fund legislation was passed at the end of 2017 as part of the tax reform bill. And what it does is allow people who are sitting on capital gains from the sale of an asset. And when I say the sale of an asset, it could be stocks, it could be land, it could be real estate, it could even be a business. It allows investors to sit on those that are sitting on those returns to defer and reduce their capital gains tax. And we're investing in projects that will be a positive impact in these disadvantaged economic opportunity zones and bring jobs to those areas. And so the three kind of key components from a tax standpoint are a temporary deferral. So if you invest your capital gains from the sale of the asset, you defer those having to pay recognized taxes and pay those gains until December 31st, 2026, or until you sell out of the investment, whichever is earlier. Then you receive a step up in basis. So if you hold the investment in the fund for 5 years, you get an increase of your tax basis of 10%. If you hold it for 7 years, you get a total increase of 15%. So there's your reduction in that initial taxes that you've invested, or capital gains you've invested. And then probably the most attractive part of this is if you hold on to this investment in the Qualified Opportunity Zone Fund for 10 years, you pay zero capital gains on the post-acquisition appreciation in gains in the fund. And this permanent exclusion will only apply if you've had gains in the Opportunity Zone Fund. So the caveat I'll put about this is the Opportunity Zone Fund legislation is complicated. As you can see, it's very tax advantaged, but I strongly recommend you talk to your tax advisor or CPA before investing in a qualified Opportunity Zone Fund. We look forward to launching ours early 2019, and we'll be bringing investors in. So think about that if you have gains. So obviously there are risks in any investment, and I would be remiss if I didn't tell you about risks. So agriculture, all investments are speculative in nature. You could lose some or all of your money. Private placements like the ones we do and list on harvest returns are illiquid, meaning don't invest money that you will need to withdraw in the near term. There's also those outside factors that affect every investment, but especially agriculture. You've got adverse weather, disease, pest infestations. Agricultural land can decrease in price like any real estate. You could have a severe drop in certain commodity prices. And there's economic downturns at the global, national, or local level. So all of these risks can be mitigated in the way we operate these, the way our sponsors operate their farms, and with the new production methods and technologies they're bringing lowers risk. And we want to make sure all investors are aware of the risk. And finally, I want to say that this webinar is for educational purposes, not investment advice. We're not offering any securities for sale here. If you want to look at the offerings on the platform, the best way to do it is to visit us at harvestreturns.com. You feel free to give us a call, shoot us an email, follow our social media on Twitter, Facebook, Instagram, LinkedIn. We've got it all. And you can check out our investments. Feel free to ask us questions anytime. We look forward to hearing from you.